With 30 June fast approaching, I thought it would be a great idea to have a conversation and ask a couple of questions of Daniel Tomei, partner at Perpetual Private, just around some of the tips and traps in relation to various super contributions and strategies that one might use prior to 30 June and beyond. One of the key things I often speak to clients about, and they often come and ask, and just a general question is contributions prior to the end of 30 June. You get a lot of clients rushing around and saying, I need to make this tax deduction. I need to make this super contribution to get a tax deduction. If you wouldn't mind just shedding a bit of light onto what are some of the contributions that a person can make and the tax consequences of each.
Look, absolutely. This is a real common part of the planning process as we come into 30th of June. Essentially, you get the opportunity to make two types of contributions. One you get a tax deduction for, and one that you don't. The concessional contribution is capped at $25,000, and it includes any superannuation guarantee contributions that may have been made on your behalf, because those have been made with before tax dollars. The other kind of contribution is a non-concessional contribution. You don't get a tax deduction for that, but you are able to contribute more, up to $100,000 per year.
So there's the contribution which is taxable up to $25,000, which you can get a tax deduction for, and then up to $100,000 that you don't claim a tax deduction for, that you use after tax money.
That's right. Interestingly, there's recent legislation called the catch-up legislation for the concessional contributions, so the tax-deductible ones, where you can actually make a catch-up contribution of up to $25,000 per year to allow you to get an extra tax deduction in this year. That's if you've missed contributions in the previous years. Okay. So this year, it's $50,000 that you can contribute and claim a tax deduction for that if you haven't done so in the last year.
Daniel, I was reading the other day about this new downsizer contribution strategy that's been legislated a little while ago. Are you able to just provide a bit more insights into that?
Yeah, look, absolutely. It is relatively new. I've seen it used by retired clients that are over 65, and also by younger clients that are helping their aged parents move into aged care and looking at selling the family home. It really is just a way for you to get, for someone to get their assets, more assets into that tax concession environment of superannuation. The rules essentially are, you need to sell a main residence, or you need to sell a property that has been a main residence at some point in time, have owned it for more than 10 years, and you're able to contribute those proceeds, up to $300,000 of those proceeds, into superannuation.
Is there anything that we should be aware of with that? I mean, it sounds really good. It sounds actually too good to sort of be true. Is there, because you'd have a lot of retirees or downsizers having that amount of equity in the home, or being able to contribute that amount. Is there anything that we should really be aware of?
Yeah, look, there's probably two key things. One is you actually don't have to meet a work test. It isn't subject to any of the contribution caps, including the total super balance of 1.6 million. So it's a real opportunity to get some funds into super. The other thing to think about is you have to make sure you're planning it really well, because you have to make the contribution within 90 days after the sale of the property. And that contribution, while it's not subject to the caps, it can affect your eligibility to make other contributions, particularly if it sends your super balance above that 1.6 million.
One of the key things I find with clients is that they have multiple employers, a hospital here, a hospital there. What are some of the key things that they need to consider in regards to multiple employers with super contributions?
Look, it's particularly relevant for medical practitioners that maybe have some private practice income, but also are operating on a VMO contract with a hospital, for instance. When you're making your contributions to super, so planning your personal contributions, your tax-deductible contributions in particular, you just have to make sure that you're aware that your VMO contract likely includes superannuation guarantee from your employer, and that is part of the $25,000 cap that you're going to be restricted to.
Okay, so if you're thinking as a private practitioner, hey, I'm going to contribute $25,000 a year into super, but you've done a bit of public work, as you've mentioned, you can be caught out.
Exactly right. So you've just got to be aware when you're doing your planning that you've taken those numbers into consideration.
One of the key questions that my clients always ask me, and you probably get asked this all the time, is can I make a can I claim a tax deduction for my super contributions? And what are the sort of the mechanics and how that works, whether you have a self-managed super fund or a industry super fund?
Look, the mechanics around a tax deduction are really making sure you're able to claim a tax deduction. So number one is ensure that you know how much you've contributed over the course of the year and how much has been contributed for you, because the superannuation guarantee forms part of that $25,000 cap. So you want to make sure you know those numbers so you don't breach the cap. The second part just has to do with ensuring you notify the trustee of your super fund that you're planning on claiming a tax deduction, because the next step, you could lose your tax deduction for that contribution if you don't ensure that's documented appropriately. So notification to the trustee and an acknowledgement that they've received that notification. This is really important because you could lose that tax deductibility if you switch super funds, or if you start a pension, or if you make a lump sum withdrawal in the meantime between making the contribution and actually claiming the tax deduction, if you haven't got that documentation in place.
It's interesting you said that, sort of notifying, because we have a lot of clients that have insurance inside super, and we go through this every year, and if they're intending to claim a tax deduction, they need to notify the insurer. So I guess it's exactly the same thing.
Yeah, exactly right.
Speaking.
And that's just one of the key things that some clients miss, and they lose that on their tax deduction.
With these unprecedented times, what are sort of some of the key things that trustees of super funds and self-managed super funds should really be aware of?
Yeah, look, this COVID-19 is a health crisis, and it's really led to some significant changes and volatility in asset prices. What we found is there's typically four things that have come out of that in terms of what we're reviewing for clients. Number one is the in-house assets rule. If you've got a loan or investment in a related party, you've effectively got to make sure that you don't go above 5% of the fund's value. With the other assets of the fund perhaps dropping down in value, there might be an issue where the assets have breached that cap. The second part is around the investment strategy of the fund, which the ATO is really looking at. Probably about 30–40% of the breaches for SMSFs are around this area. And with, again, assets fluctuating like they have, your super fund might be out of balance, and particularly outside the ranges that are put into place in your investment strategy. So that needs to be reviewed right away, both of those things. The third one is with the interest rates where they're at the moment. A lot of us are looking to refinance loans. The real trap for those self-managed super funds that own property is to make sure that those assets aren't commingled with your personal property, your investment property, when you're looking at refinancing. And that's around LVRs and security for the loan. It's prohibited, and it can lead to your fund being non-compliant. Finally, for those clients that have business real property, perhaps, it owns the practice that you're working in, and you're a tenant. In the past, basically the rule is you've got to have an arm's length and at market rental rates in place to allow that exception to the rule. During COVID-19, that's been recognized that a lot of practices, a lot of businesses are having some issues with cash flow, et cetera. So if your practice is financially affected, for FY20 and FY21, the ATO is allowing an SMSF as an owner of the property to allow rent relief to a tenant, even if it's a related party.
That's a really interesting point, number four, because I've got, we as a business have countless amount of clients that have their property through their self-managed super fund. And I guess, to be able to provide rent relief and not have to be governed by a strict arm's length or rental agreement, as you mentioned, I mean, that's great. That's fantastic.
Look, really important though, it has to be genuine, of course, and it has to be really well documented. In fact, typically we'd recommend getting a private ruling from the ATO to make sure that it's all okay.
Daniel, those are all sort of some really great points. If you don't mind, sort of just for some of our clients, just a bit of a summary.
Yeah, look, in summary, it's wise to do some planning near the end of the financial year, which is really coming upon us quite quickly. Check your eligibility to contribute to super and where you might be able to claim a tax deduction, particularly where you might be eligible for some of the new provisions that are in place, like downsizer or the catch-up provision where you can get a tax deduction for a bit more this year. Plan the amounts and timing of your contribution so you don't breach the contribution caps. And don't miss out on your tax deduction by switching funds or taking money out of super. Finally, with the consequences of COVID-19 entrenched, there are some investment risks and risks within self-managed super funds that need to be reviewed immediately. There are also some opportunities for relief if your self-managed super fund owns a property that your practice works in and your practice has been financially impacted.